Hi viewers, we are going to talk about accounting basics today. Accounting is a subject which is useful for everyone. Even if you are not an accounting student or accounting professional, it is better if you know the basics of accounting, because if you are investing your money into a company, we'll see that you are buying company shares. Then you will be provided with the financial statements. You should have the knowledge to read that. You want to manage your personal finances. And if you are working in a organization where you are working in a non-accounting department, administration department or sales department, then the reports comes. You should be able to understand what is in the report. You can't every time go to the accountant to explain it. So the knowledge of accounting is essential for everyone. And if you know the big picture, that will be useful for you to get to know what is happening in the accounting field. So we will see the big picture today. I'm going to explain you the big picture of accounting basics, and you will know what from transactions to the financial statement, what is going on and how the reports are generated and how can we read the reports. We will see that. So we will do accounting basics today, and in accounting there are two types. One is management accounting, one is financial accounting. Financial accounting is for everybody. That's what we are going to see that today, because that is the one that generates financial statement for general purpose. But the management accounting is for the managers and directors to run the company, which we are not worried about. So we will see financial accounting basics today. The financial accounting, it generates financial statements for the users to read and understand. So how can we define it? Accounting is a process of identifying, recording, analyzing, and summarizing transactions to prepare financial statements for the users to make economic decisions. Note the word economic decision. What is the economic decision? Generally, the users are primary and the other users. The primary users provide resources to the business or the company. They are like investors, like you. If you want to start a company, you provide capital. You take it out from your savings and invest it. You provide resources to the business. Then there are creditors. They give credit for purchases and other facilities, that they are creditors. They are giving their money for you to function. Then the banks and the other financial institution who lend you money to do your business. So all these people are primary users, and they are very much interested in your performance of the organization. Why? Because they want to get their money back with the interest. So they are very much watchful how you are progressing in your business. So for these users, what is the report that we can give? We can give the financial statements and how the financial statements are prepared. Through the accounting process, we will see shortly, and starting with the transactions. The economic decisions by primary users are for providing resources to the business entity. So they are providing resources. Primary users are investors, potential investors, other creditors and lenders. Those are you and the people like you going to invest in a business or buy some shares or lend some banking. If you are a bank, you are lending something to the business, so you are interested. Other users are managers, employees, customers, suppliers, government and community. Managers and employees are interested in the financial report because they want to see whether the company is running profitably, to secure their jobs, their bonuses, their income, their salary increases, So they are worried about the performance of the business. So they are depending on the financial statements to get to know about the performance of the business. Then the suppliers. The business purchase goods on credit from the suppliers. So the suppliers wants to know whether their goods are selling, whether you will be able to pay their dues back. They sell it to you profitably, so they are making a profit. So they want to check on your performance. Then the government is interested in your performance because the tax revenue is depending on your performance. And the community as a whole, for several purposes, the environmental issues, they are interested in your business. When your business starts, the traffic will increase, whether they can manage the traffic or whether there is any pollution to the environment. So they are interested in your business, what you are doing. So these people are interested in your business. So we will see what is the accounting process. How we are going to prepare the financial statement from the transactions. It starts from the transaction. What is transaction? It is the goods or services provided for exchange of money. It is measured by money. There are exchanges. So these are the transaction. Every day it happens in a business. So every day's transactions you have to identify first. Then you have to record all these transactions. Because these transactions are the input, like raw materials, for the output of financial statements. So recording transactions, where we can record, we have to record in day books. The day books are called journals. Every day's transaction you have to keep on recording. To record the transaction, you need some proof that the transactions are taken place. So what is the proof? It is the source document. For example, if you deposit a check, the deposit slip is a source document. If you sell something to a customer, the sales invoice is a proof. So that is a source document. If you make a payment to electricity, the payment voucher is a source document. So from this source document, you keep on entering the transactions in the day books. What are the day books? We will see shortly. So after entering this transaction is the day book, you total it up and post it to a T account in a ledger. The ledger means collection of T accounts. What is T account? I'll be explaining shortly. That is the account that collect all your expenses, income, and all other transactions. It collects. We keep on posting to the T account. So it gets collected. And from there, we extract a trial balance. Trial balance are the balances of T accounts in the general ledger, which should balance. It will be two columns. One is debit column, one is credit column. We will see the double entry principle. Then you will know that it should balance. The T accounts or the trial balance should balance, extracted from the T account. After extracting the balances of the accounts, then we can prepare the financial statement. What are the financial statements? What we prepare? Profit or loss statement, that is called income statement. Then the statement of financial position, it's the balance sheet. These are the two main important statements that we prepare from our accounting process. In addition, we prepare cash flow statement as well for the purpose of understanding how the cash comes and goes and remain. So we have to see that. So we will see now the day books. Recording transaction in journals. What are the day books? Day books are called journals. The journals are 7 types. You can see that sales journal, purchase journal, cash book, petty cash book, sales return journal, purchase return journal, and general journal. These are 7 types. Each type of transactions is entered into each type of journal. As you saw, sales journal, you enter all the credit sales. Remember credit sales. Purchase journal, all the credit purchase. Why only credit purchase? Because you have to identify the customer and the supplier. That's what we enter it separately. All the cash purchases, you need not to worry about them because the cash has come in, entered in the cash book. And there are petty expenses like electricity, not electricity, transport, stamp, postage, and all these petty expenses, we maintain a petty cash book. Then the sales return, you can get the customers return their goods. That also we enter separately and keep it. The purchase, we return goods to the supplier. That also we enter separately and keep it. Then all these ledgers, all the 6 ledgers, whatever the transactions are not capturing, they are captured in general journal. Like buying a fixed asset. If you purchase a fixed asset, you can't record in all these 6. So you put a general journal and put a debit and credit. What is a debit and credit? We will see shortly. We will move on. Now we will see the dual effect of a transaction. A transaction, whether you purchase a car, whether you sell your goods, whether you provide a service, every transaction has 2 sides and every transaction entered twice. That is the double entry accounting. That means one side is debit, one side is credit. So the T accounts, it's called the T accounts in the general ledger because it shows a appearance of a T. On the T, there is a left side and there is a right side. Left side always called debit side. Right side is always called credit side. So when a transaction happens, there will be a debit and there will be a credit. Twice it is entered in 2 different types of accounts. There are types of accounts. What are the types of accounts? We'll see. Assets, liability, equity. Equity means owner's capital. Then income and expenses. These are the 5 types of accounts that we maintain. It's called the elements of financial statement. Whatever the transaction it happens, it has to fix into these things. It will be either a purchase of asset or payment of a liability or owner's investment or revenue from sales or expenses paid for the business. So you have to classify the expense transaction into these 5 types. That means that to fix the transaction into one of these types or 2 of these, several of these types. So we will see how the transactions are entered. The accounting equation is the fundamental for double entry bookkeeping or double entry accounting. Now it's called. That is, the sources of the funds are from owner, equity, and the lender, the liabilities, the bank. These 2 are the source. When they provide the resources, you go and purchase the assets. So to the extent of the provision of resources only, you can purchase the asset. So that's why always assets are the destination. It is called the source. The assets are equal to equity plus liability. These 2 are the people who are going to lend you money, provide you resources. So this is the basic on which the double entry bookkeeping is built. Then now we will see what is double entry accounting. There are some rules. When there is a debit, always there is a credit. That is the double entry. There are 5 types of accounts that we already saw. Those are assets, liabilities, equity, income, and expenses. So what will be the double entry rule for these 5 types of accounts? Assets and expenses, if you notice, assets and expenses increase will be debited. decrease will be credited. For liabilities, equity and income, increase will be credited, decrease will be debited. For example, if you buy an asset for cash, both the assets, motor car for cash. So cash is decreasing, motor car is increasing. So asset increase will debit, cash asset decrease will be credited. Like that only the double entry rule works. It might be little complicated for you. I'll be taking up a story. Then from the story you will understand what is this double entry and how this is working out. We'll take a story. Ajanta is a sole trader. Sole trader means she is the one and only owner of the business. She is starting a business on 1st January 24 and brought in $30,000 as capital. She is bringing in all her savings to the business as capital. She buys and sells fruits. Imagine she buys 1,000 apples every day from the supplier for $1 and sells it at 110. So she keeps a profit and sell it. We assume that she doesn't carry any stock to the following day. She buys 1,000 and sells 1,000 on the same day. She doesn't keep any stock for a day. And she buys apple for cash. And she buys the apple for cash, not for credit. She is not buying it for credit. And does not have any credit facilities with the supplier. She doesn't have any credit facility. So she has to pay, in the morning she has to pay $1,000 and by an evening she will sell it and bring the sales value home. There is no apple remaining. So she likes to know for 30 days. We assume in January there are 30 days, 31 days. For easy purpose of calculation, I am assuming January 30 days. For the 30 days, end of January, we will see 30th of January. She wants to know how much profit she has made. Then we will see what she is going to do. Ajanta buys 1,000 apple for $1. She buys it every day. For 30 days in January, she would have spent $30,000. At the same time, she would have received $33,000 as a sale. 110 into 1,000 into 30 days is $33,000 as sales for that 30 days. So how she is going to record these transactions in the books of accounts, we will see. She will, first of all, when she brings in the capital, 30,000 comes in as cash to the business and her capital, because the business and the owner is treated as separate people. Business is separate from owner. It's called the entity concept. So we take it, the owner is bringing in, owner is giving 30,000 to the business. So the cash comes in 30,000 and her capital of the business gets credited because capital increase is credit. If you see the rule on the previous slide, you will see if it is for capital or equity, the increase is credited. Cash is an asset, the increase is debited. So that happens on the very first day. Then what happened? At the end of the 30th day, the cash purchases 30,000. The purchases is an expense, so it gets increase. Increase is a debit. Then the cash itself is an asset. It's decrease. Decrease is a credit, so it's get credited. So again, revenue comes in. Sales comes in, 33,000 she receives. So the 33,000 is get debited because the cash is an asset is increasing. So the sales is an income, it increases, so it gets credited. So what will happen next? She she will be paying some expenses also. For the month, we assume she has paid rent, electricity 10, telephone 5, fuel 15. These are hypothetical figures we are assuming. So what happened? Now she wants to find out, she has received this, she has spent this, what is the profit that she has made? So the help is income statement, that what we provide, income statement. Her income is 33,000 for the 30 days. And it has costed her 30,000. So when you receive sales and deduct the cost of sales, the profit what you are getting is the gross profit. Because beyond that you have the expenses to meet. So from that 3,000 what she has made from selling the apple, she has spent expenses 50. So she has got 2,950 at the end of the 30th day. That is her profit. Now the statement of financial position. How we will show? She has to show the statement of financial position, that is the balance sheet. That shows her the statement of financial position. Meaning is that it shows the position as on one day, the last day, the 30th of January. So we will extract it on 1st January. Her position is she has cash and she has equity. So these two should balance. Balance sheet should always balance, and it is based on the accounting equation principle. Assets is equal to equity plus liabilities. There is no liability, so assets is equal to equity. This should always balance. Then the statement of financial position as on 31 January or 30th January. What happened? She has 32,950 in cash now. The capital 30 has come back, and in addition she has made a profit. So here again assets are equal to equity. Equity means including profit. What belongs to the owner is equity. The residue after taking the assets and paying off the liability, the net is the equity. If you rearrange the accounting equation, it comes. Asset is equal to capital plus or equity plus liability. If you rearrange, assets minus liability will be equity. So the owner's equity includes the profit. So this is balancing. This is the overall big picture of your accounting basics. So the nitty-gritties we will learn in the subsequent videos. This is the basic, this is the big picture. Within that, there are so many nitty-gritties that we can learn leisurely in separate videos. So that's all. Thank you. Goodbye.